What happens when a US president challenges the banks? And look, that's not just some hypothetical question. The Trump administration just made a big move, that could completely reshape crypto and stocks. So let's get right into it and break down exactly what's going on. Okay, so for years, you've had this massive wall, right? Separating old school banking from the wild world of crypto. Well, it looks like the current administration is ready to take a sledgehammer to that wall. So you might be wondering, why was this wall even there? Well, it wasn't that long ago, just back in early 2023, that regulators were basically screaming from the rooftops, telling banks to stay away from crypto. They put out these formal warnings saying that getting involved was, and I'm quoting here, highly likely to be inconsistent with safe and sound banking practices. They were worried about liquidity risks, a total lack of oversight. Basically, the message to the big banks was crystal clear: don't touch it. But now, whoa, the rules of the game are changing. And I mean, they are changing fast. We're talking about a complete 180-degree regulatory reversal here. I mean, just look at this timeline. It's been a whirlwind. In just the last few months, federal regulators have been taking that wall apart, brick by brick. First, in April, you had the FDIC and the Fed pull back their old warnings. Then in May, the SEC gets rid of a rule that made it way too expensive for banks to even hold crypto. And now, the OCC, they're swinging the door wide open for banks to jump in. Okay, a really key piece of this puzzle is something called a riskless principal transaction. Sounds complicated, but it's not. All it means in simple terms is that a bank can now act like a broker, a middleman. They can buy crypto from one client and instantly sell it to another. The magic here is that they get to profit from the trade, but they never actually have to hold that super volatile crypto on their own balance sheet. It's a clever way for them to facilitate trades without actually taking on all the risk. And this simple change, it unlocks a whole new world for banks. Suddenly, they can officially offer crypto custody services, they can hold the reserves for stablecoins, and they can execute trades for all their big clients. When you think about where things were just a couple of years ago, this is an absolute seismic shift. Now, this kind of rapid-fire deregulation, it doesn't just happen quietly. Oh no, it has ignited a massive power struggle in the financial world. And trust me, the battle lines are being drawn as we speak. So in one corner, you've got team deregulation. This is the Trump administration, all the big crypto firms, and their argument is that these changes are going to spark innovation and let American companies finally compete on a global scale. But in the other corner, you've got team caution. This is the old guard banking lobby and a lot of consumer advocates, and they are ringing every alarm bell they can find, warning about huge systemic risks and the fact that everyday investors could get seriously hurt. And let's be clear, the traditional banking industry is, well, they're worried. The Bank Policy Institute is basically saying that crypto companies are trying to get all the powers of a bank through the back door without any of the strict supervision. For them, this isn't a level playing field. They see it as a threat to the entire financial system. And if you think the banks are worried, the consumer advocates are sounding an even louder alarm. The Center for American Progress is pointing out that these new rules, they're missing the guardrails. You know, the things that protect us from fraud, money laundering, and market manipulation. Their whole point is, hey, this isn't just a crypto thing anymore. This is about exposing the entire US economy to some brand new and potentially catastrophic risks. So, all of this, it all leads to the multi-trillion-dollar question. With that old wall crumbling down, what happens when the floodgates finally open? What happens when all that institutional money starts to pour in? Right. Let's get down to it. What does this actually mean for the market? More importantly, what does it mean for your investments, whether you're in crypto, stocks, or both? Well, according to a brand new analysis from JP Morgan, it could mean this: $170,000. That's not a typo. That is their theoretical price target for one Bitcoin. Okay, hold on. That number isn't just pulled out of thin air. It's not some wild guess. It actually comes from a pretty serious model built by JP Morgan's top analysts. Here's what they did. They asked a simple question. What if Bitcoin were valued like gold is? You know, as a safe haven asset. They did the math, adjusted for how much more volatile Bitcoin is, and figured out that for its value to match the amount of private money currently parked in gold, its price would have to soar. And that's how they landed on that massive $170,000 target. And a number like that, it perfectly highlights the two completely different futures we could be heading towards. It's the ultimate showdown, the bull versus the bear. So yeah, We're basically standing at a fork in the road right now. One path, that's the bull case. It leads to a massive win for the markets. But the other path, that's the bear case, and it could lead to a really catastrophic risk. Let's walk down both paths and see where they go. All right, first, the bull case. This one's pretty easy to get excited about. The idea is, with clear rules from the government, all those trillions of dollars sitting on the sidelines with banks and big asset managers, it can finally flood into digital assets. This would be a huge stamp of approval, legitimizing the whole space. It could fuel just incredible growth, not just in crypto, but in related tech stocks too. We're talking about a massive acceleration in financial innovation. But then there's the bear case. And honestly, it's just as believable, and frankly, a bit terrifying. I mean, we've all seen this movie before, right? Remember FTX? Remember Celsius? Those companies collapsed precisely because they were operating with almost no real oversight. So the critics are arguing that if we rush this deregulation, we're just inviting the same kind of fraud and manipulation back in. And this time, it could create a domino effect that takes down a big chunk of the financial system with it. Which brings everything back to you. We've looked at the political fight, the huge regulatory shift, and the two very different futures ahead of us. So now it's time for your verdict. So what is it? Is this whole thing a massive win that's about to unlock a new era of wealth for crypto and stocks? Or is it a reckless risk, one that could blow up in our faces and destabilize everything? I really want to know what you think. Drop a comment below, just type win or risk. And hey, make sure you're subscribed because you are not going to want to miss how this story unfolds. We'll be tracking every single move.